Hi everyone, thanks for tuning in again to In.Corp's Pro Business Series. I'm Eric, In.Corp's Chief Business Development Officer and your host for today. At In.Corp, we specialize in providing a wide range of corporate services and business advisory services in 8 markets of Asia Pacific. So for more information, please visit our website at www.incorp.asia. So in this episode, In.Corp is proud to be partnering with a fellow Prime Global Association member, Buzzacott, a top accounting and advisory firm based in UK. We'll be discussing the opportunities and considerations of commercial real estate investments in the UK market. For our audience's knowledge, Prime Global is an award-winning association of independent accounting and business advisory firms, comprising of more than 300 highly successful independent member firms in over 100 countries. Prime Global provides its independent member firms with tools and resources to help them furnish superior accounting, auditing, tax, and advisory services to clients around the globe. For today's episode, we have with us Phil Westerman and Liam McKeevor from Buzzacott. Phil and Liam, do you want to give the audience a self-introduction of your role and your expertise with Buzzacott?
Thanks, Eric. So Phil Westerman, I'm a partner in the corporate assurance team in Buzzacott, and I lead the firm's real estate sector group.
Yeah, and I'm Liam McKeevor. I'm a partner in Buzzacott's corporate tax team, specialising in advising groups and in particular property groups, whether they be UK headed, expanding overseas or investing into the UK.
Thank you, Phil and Liam. So maybe let's start the discussion proper on the topic today, which is centric around UK real estate investment in the commercial space in terms of opportunities and considerations. So maybe to warm up our listeners and audience today, right? The global economy has been hard hit by COVID for the past 2 years, and coupled with the Russian-Ukraine war, coupled with central banks rapidly increasing interest rates to fight inflation and possibly the risk of recession in key economies of the world. So in your opinion, how is the commercial UK real estate sector is going to perform in 2022 and beyond?
Sure. Just stepping back a little bit and looking at the challenges of the last few years from, in the UK, obviously dealing with initially Brexit and then obviously straight into COVID and the pandemic, and then more recently the impacts of the Russia-Ukraine conflict. It's going into that period of time, UK commercial real estate has been one of the strongest performing sectors in the UK in terms of performance, returns for investors, very appealing as an investment opportunity for both UK and overseas investors. So we went into all of those challenges in a pretty good place as a sector. The commercial real estate sector was strong, having ridden some of what was often described here as a perfect storm, the perfect storm of all three of those things, as well as the day-to-day challenges of operating anywhere in the world. There was quite a lot of optimism at the start of 2022 in terms of coming out of the pandemic, people returning to work, the offices in the cities, filling up again with people, retail reopening, hospitality getting back on its feet and back to normal. So there was quite a wave of optimism, and that sort of led in the back half of 2021 and into 2022 a significant increase in activity. So in terms of property related deals, activity in refurbishing and reconfiguring offices in the city, people redesigning retail space, reopening businesses that have been closed for a long period of time. Everything was sort of looking relatively positive, and activity was increasing, valuations were increasing again, and in certain areas, and we'll come on, I think, to talk about the various subsectors of commercial real estate in the UK, because there are some very notable differences between those. Then the combination of the Russia-Ukraine situation and what's described here as the cost of living crisis, which is not just UK related, with another, the interest rates increasing, the inflation and pressures on the supply chain, the cost of living and consumer spending abilities, or people just generally being in not such a great place. Real estate's not in anywhere near as bad a place as certain sectors and certain industries, but it is obviously directly impacted by all of those three things. So I personally don't think that it's anything like crisis point for real estate in the UK. It's still an appealing investment opportunity. People are just having to think about things very differently, and they're having to look at returns they want, how they use the space they own. Occupiers are changing their views on what they need. And so there is still some positivity, albeit accepting, I think, that the next 2 years in particular will be particularly challenging.
Thank you, Phil. I mean, so it seems to me that there are still opportunities in the market, and it's not like because of all these macro issues, like there's zero opportunities. In Asia or in Singapore per se, right? I mean, we deal with many clients and many high net worth investors. So when they talk about UK commercial real estate, I think a very typical question is it only a London market, or there are surrounding regional cities or cities within UK that is interesting as well?
London is different to the other parts of the UK, but it's certainly not only London market for commercial real estate. Different investors have different appetites. So if you stretch commercial real estate and look at logistics, warehouses, that's not a London thing. That's regional, where there's space, it's out of town. Similarly, things like community-based shopping malls, that is in smaller cities, smaller towns outside of London. And then in terms of office space, obviously that is dominated by the cities. It's dominated by London, but the other big metropolitan hubs in the UK, Manchester, Birmingham, Leeds, Newcastle, you go to the regions, Glasgow and Edinburgh in Scotland. Those markets are different, but still appealing to commercial real estate investment.
I mean, Liam, you want to add on anything before we move on to the more tax-related topics for foreign investors going into UK? But do you want to add on this point?
I think the only thing to add there is the government is keen to sort of bring up other areas of the UK, and while sort of detailed measures is still really coming through, there are things the details starting to come through. For example, the UK, the government's looking to open 3 ports in various locations. And while a lot of the tax incentives of 3 ports are mainly driven towards the businesses that will trade and operate from them, there are some property benefits. For example, there's a relief from stamp duty land tax where you're investing in those sites and buying land. The stamp duty land tax on commercial property can be up to 5% of the purchase price.
And I think just to add to that, Liam, it's a really valid point actually, because the government's sort of strategy and relatively high on their priority list is the sort of levelling up and the investment in infrastructure and trying to provide opportunities for people to want to invest in areas outside of London. London has kind of its own appeal because of it is, and the place to be and all that sort of stuff, but there is a strong push to incentivize people to invest in other parts of the UK, and that is backed up by the investment in infrastructure to make other parts of the UK better connected.
Understand. When we talk about the term commercial real estate, I mean, it's a very broad term, right? And there are several sectors or segments of properties within commercial. It can be retail, it can be offices, for example. To be more specific and for the audience to understand better, can both of you talk about a little bit of the different sectors and what are the interesting investment opportunities, say within retail, commercial, or hotel, for example?
Yes, there are various subsectors. I think in headline terms, you've got offices, you've got retail units, you've got hospitality, you've probably got pubs, cafes, you've got leisure facilities, and then you look at that both sort of in town, so you've got high street retail, and then you will have out of town shopping or out of town business parks or out of town leisure units like bowling alleys, cinemas, and that sort of thing. The sectors are different. They are impacted differently by the economy. They are facing different challenges depending on where we're at in the sort of cycle. And again, that is also regionalised in terms of where in the modern world, where people need to be or want to be. And actually, that's coming back to the earlier point on London versus regions. Actually, the increased level of working from home has slightly changed people's views on where they need their offices to be, for example. A range of subsectors within commercial real estate, they are the main ones, and they are all facing different challenges.
Okay. In terms of the impact, I mean, rising interest rate is definitely an issue. I mean, for global investors, when they are looking at investing in the UK, with interest rates going up, right, would that impact on yields or returns in this very challenging environment?
Yeah, I think the interest rate rises impact in a number of ways. So the initial investment opportunity and the desired or required rate of return on that investment, if there is an external financing requirement. 2 things to point out, I think, is one, that financing is perhaps less readily available in certain areas. So if you're looking at a well or a lowly geared established asset of high value that sits in a large corporate, you may well have better access to competitive financing arrangements through existing relationships with lenders and mainstream banks. So availability of finance is one of the challenges. And secondly, the simple fact of the cost of that finance being higher. Availability of finance is leading people to look at alternative sources of funding. So away from a mainstream sort of mortgage related asset facility to mezzanine finance, I'm seeing more higher levels of investment from the investor and shareholder and lower external financing being provided on assets, or people are structuring their deals in different ways in that they're perhaps being initially funded by the private investment, and then at a point subsequent to that, when the asset has perhaps been revamped or refurbished or improved in terms of its tenant covenants and the like, then that's when people are going to the lenders to better position themselves. The other really notable impact, I think, is perhaps on the developers. So the people who are actually building the commercial real estate assets, and availability of development finance is even harder to source than sort of investment property backed lending. It's got a different and higher risk profile. It's more expensive. People are willing to lend less in terms of expected loan to value to fund those developments. People are looking to get end buyers for the developments or pre-funded projects or pre-secured sales, as well as tenants in place for when the asset is completed. So it's changing that landscape, but it's also making the build more expensive for the developer. Both the interest rate, and I'm sure we'll come on to talk about the cost of doing anything in any business at the moment in terms of the inflationary impact on the global economy at the moment. But all of those things are driving slight changes in behaviour in the investor community in how they structure their projects, and that's kind of it leads on to a number of things in the sort of tax world in terms of consequences of how people are setting those things up.
I think before I pass the mic, I pose a question on tax related to Liam. I think from the Asia perspective, many high net worth families have set up, say, family offices in Singapore. And the private banks in Singapore are very competitive when it comes to financing UK-driven investment opportunities. I guess credit is definitely out there for the well-banked individuals, families, or large corporates who do want to look at investing into commercial real estate in the UK. So credit is available in Asia. I don't know how much of that is available within Europe or UK. But I guess for the audiences, if you're very well banked, you're a private banking client, I think some of your private bankers will be very interested to finance. And I think on this topic, right, for foreigners, say Asian investors, right, if they're looking to go into commercial real estate, I think tax is always one thing. It's a very big consideration. People want to understand what are their tax considerations or impact, positive or negative, right, when it comes to going into UK. Maybe Liam, I think this definitely is a question for you. How would you advise a foreign investor, right, when it comes to the tax perspective? Are there tax incentives, or is the government welcoming for that?
Yeah, so I mean, I suppose in terms of the government's welcoming, the government certainly commercial real estate is very welcoming of overseas investment into the UK. Having said that, it also does see UK property and the profits and gains that arise from it as a source of tax revenue. And the UK, like many countries, is a mixture of COVID. As tax revenues hit. So whether we actually see property come under renewed focus is something we'll see in probably coming years. And kind of flip side of that is there's not a significant number of sort of massive tax incentives to invest in the UK and in property, but there's not disincentives. Broadly, if you're investing as an overseas investor in UK land and property, you're going to pay UK tax on the gains that arise, or you're going to pay UK tax on the on your rental income, or on if it's development on the development profits. And that's quite a change from where the UK has been historically. If you go back probably just over 10 years ago, a foreign investor wouldn't face any UK capital gains tax on UK property. On a commercial side, actually, you don't have to go back a decade ago. You only have to go back 3 or 4 years, and commercial property, which is outside the scope of UK capital gains tax. Okay. That changed in 2019. and the rules are quite tight, whether you're investing directly into UK property or indirectly, perhaps through sort of right offshore companies. If those companies are also property rich, you will still end up facing a UK tax charge. And so for an investor coming in, it's always useful to understand what's the structure of investment, what's the as a family office, what's the structure of that look like, how they're going to invest in, what's the funding structure, how is loan financing coming in, how is equity financing coming in. Given that UK property is now subject to UK tax, we broadly find that actually investors will typically set up a UK company that will hold property, whether it's for development or ongoing sort of rental receipts. But UK company, there's no withholding tax and dividends, which makes things quite clear in terms of profits going up. But you are going to have UK corporation tax,
which is high versus Singapore, for example. Talking about the structuring part, I think that's what the listeners today will probably want to understand a bit better. So while there's no one size fit all structure for foreigners going and investing into a commercial real estate, maybe you can share what are the common structures for investors to consider. For example, do they need to form a UK entity as a SPV to acquire the asset, or they can own it outright as a foreign non-resident company or individual?
They can own it outright as a foreign investor, but actually, given the fact that they're going to face UK tax anyway on it, typically investors now are setting up UK SPVs to hold a property, but you're going to have to file a UK tax return regardless of how you hold it. So it's usually cleaner to have a UK SPV. It keeps things separate, it keeps things in a sort of UK package. UK companies are and UK commercial corporate law is sort of a relatively known form. The UK is actually, if you hold it in a UK company, you've got UK corporation tax. As I mentioned, you're going to have that regardless of how you structure it. Even if you invest from an overseas entity, you're going to have UK corporation tax. We don't withhold tax and dividends, so if you do make profits, then go out pay out. What other consideration got? In terms of loan funding going in, there is considerations around how that's financed and what's the overall financing structure. The UK, like many other countries, now has a number of rules around corporate interest restriction, high-grade loan instruments. So I'd always advise on the start, actually, to step back and look at the global structure, how financing is coming in, how it's coming in before you put it in place. So actually you're not being tripped up by any of the UK anti-avoidance rules around interest restriction or hybrid instruments. They're manageable, but they just need consideration up front, really.
Just linking back to the point we discussed previously on financing and where that external financing is coming from, whether it's Singapore banks or UK banks, certainly the UK corporate would have a degree of transparency in the UK if somebody was looking for UK funding.
Yep.
The banks would often require that set of accounts, financial statements, and a statutory audit to go alongside it if required as part of a lending arrangement. And it does sometimes just give a cleaner picture if you're looking at borrowing against that asset in the UK, sat in the UK SPV. Obviously coming with an element of compliance cost, inevitably.
Understand. Talking about the UK government, we have seen in Asia, in markets like Singapore and Hong Kong, which is well known to have high property prices, commercial or residential. The government has several measures to, I wouldn't say deter global investors from coming in, but they set the bar a bit higher when it comes to policies, when it comes to tax regime, to try to control the prices, to make it affordable for local companies or local individuals. For the UK government, as a forward-looking regime, is the government going to control and implement restrictions to control the prices of commercial real estate? What do you think?
I think there is no current formal proposal on that subject in terms of restricting prices. I think there's probably, personal view maybe, there's probably an assessment being made that actually prices are relatively under control at the moment, just by nature of what's happened over the last few years. So by way of an example, if you look at the historic relationship between commercial landlords and their tenants, a huge amount of the power, negotiating power, sat with the landlord.
Yep.
Running through the last couple of years of restrictions, pandemic related restrictions, a lot of that power shifted to the tenant in terms of negotiating rents, negotiating lease incentives, rent-free periods, investment from the landlord in improving properties. So you've kind of had, in terms of the rental market for commercial real estate, you've kind of had an adjustment already from a market that was actually viewed by many as, certainly in central London, becoming unaffordable for all but the biggest businesses in terms of the rent per square foot in the square mile of the City of London. And that obviously then feeds out to the regions from here. So that pricing, the majority of commercial real estate assets will be valued based on the rent roll, the quality of the tenants, or the nature of the tenants, the strength of the tenant covenant, the length of leases in place till break clauses kicked in. That landscape's changed quite a lot over the last couple of years. And so as a result, whilst there hasn't been a huge drop in value, there was a dip largely because there wasn't an active market for a period of time, actually, and there were very few comparable transactions to look at. A recovery has happened in a number of assets coming out of the pandemic, but we haven't seen that sort of price inflation and value inflation outside of, say, sector like industrial logistics, where that sort of went a bit mad in terms of the demand for out-of-town sheds or warehouses, and a number of those that went up, and the value shift in those assets where people were, releasing them on longer, better lease arrangements to bigger tenants, e.g. Amazon. That sector has seen a huge growth in valuation over the last 18 months.
I guess for industrial and logistic real estate assets, it may be driven up by all the REITs of the world who are very hungry when it comes to deploying AUM and funds, right, to acquire versus and fighting against one and the other. I mean, Singapore has a very strong REIT market, so we can see that a lot of the REITs around the world are actively trying to buy assets all around the world. Obviously, UK will be in this space when it comes to industrial and logistics hub. And coupled with the growth of e-commerce over the last 2-3 years, probably because of COVID, that will probably contribute to the high rising prices for those type of assets.
Yeah, I'd agree, but there are also numerous examples of private investors setting up their own funds or structures to invest in logistics portfolios. Certainly, I've seen Europe and the UK. And they've grown very, very quickly because they've had that funding available, and the value shift has been double digit since buying them 18 months ago. So you see that side of it. It's an interesting point you make, Eric, about the e-commerce, because interesting and slightly obvious in one hand, in that increase in e-commerce and value shift in logistics has a direct sort of counter in the reduction in footfall on the high street and in shopping centres, and people actually going into shops, and therefore the viability of retail businesses and the valuation of retail assets. And it's something I sort of, when we started, I meant to say when we were talking about the subsectors of real estate, there's actually quite a strong move now where we have a lot of mixed use development, because people don't want to put all of their eggs in one basket anymore, and they would rather, for commercial real estate, you'd have office, retail, and perhaps hospitality, all in the same building that perhaps was originally just an office building, and it's been redesigned and reconfigured to make it more appealing, offices with gyms and with cafes, in them, more appealing proposition. And I know we're not talking about residential today, but within that mixed use sphere, and what people are looking at obviously includes buildings that are now residential with retail underneath, and with hospitality within that offering, is something that we're seeing more and more of, and appealing to overseas and UK investors in kind of risk mitigating what you've in your asset.
I mean, there's many considerations, I would say structures to think about, other than the type of assets to invest into. For all the listeners here today, I mean, if you're looking at UK assets, especially in the commercial space, do look to Phil and Liam from Buzzacott to seek for advice. And I'm sure between the both of them, they will be able to give you the best advice on which are the segments you should go for and what are the structures you should to think about and consider. So I guess for Phil and Liam, to round off the episode, for the audience here today, each of you can come up with, I would say, a piece of advice for all the global investors out there today who's looking at specifically at the commercial real estate space in the UK. What is the one piece of advice you will give to, say, foreign investors?
Before I give the advice, the UK remains an attractive proposition for overseas and UK investment. The returns are still good. The assets are still strong, commercial real estate. I would advise and suggest that before investing in the UK, people consider the best use of the assets they're looking to acquire. They need to be a little bit more innovative about how they structure the use of that asset to get the best returns.
Thank you, Liam.
I think my advice, very much from the tax side, but it would be plan ahead and get the advice early on, so you're not, the property is definitely in the target of it's high value, there's potentially a lot of tax revenue there, so the tax rules are always changing. But if you plan ahead and think about it in advance and get things set up right, it's manageable.
And you'll be profitable, right?
Yeah, manageable and therefore more profitable without being punished by tax. Yeah.
Thank you both, and thanks to our audience who is listening in to this recording. So thanks again, Phil and Liam. I think it's a very interesting discussion. I will know that there's plenty of things that you can share with any of the investors out there who's looking at UK properties. So to all the audience today, thanks for listening in to our recording. We will look forward to have another episode between In.Corp as well as Buzzacott for our Pro Business series. Thanks again.
Thank you.
Cool. Thanks.